Welcome back. So let's talk about India Inc.'s health from a credit profile point of view. Now, according to ICRA, FY25 marked the fourth consecutive year of improving credit profiles. CareEdge says that these upgrades have been driven largely by strong domestic consumption as well as government spending. Meanwhile, Crisil also remains quite positive on the credit outlook for FY26. So to talk about all of this, we have with us Somasekhar Vemuri, Chief Criteria Officer and Senior Director at Crisil Ratings, Sachin Gupta, Chief Ratings Officer at CareEdge Ratings. And we also have with us Ravichandran, Chief Ratings Officer at ICRA. Gentlemen, thank you very much for joining in. Somasekhar, if I could start with you first, just tell us, what is expected, this improvement that we've seen in credit profiles all throughout FY25, do you expect it to last in the new financial year as well?
Thanks. Just to look at what has happened in the second half of last year, we had 423 rating upgrades and 160 rating downgrades, resulting in a credit ratio of 2.64 times. The upgrade rate was about 12.2%, downgrade rate was about 4.6%. And in terms of sectoral breakup, largely, you see the infra and infra-linked sectors turned out to be fairly buoyant and hence, contributed a lot of upgrades. On the other side, the export-oriented sectors such as specialty chemicals, agrochemicals, they saw a little bit of pressure. And going into fiscal 26, we continue the credit quality outlook also to be favorable, given that we expect a spur in the consumption demand on account of the announced budget tax breaks, the easing inflation, as well as the expected rate cuts. In addition, the continued thrust from the government side on infra spends will augur well for the infra and infra-linked sectors as well.
Gentlemen, morning. Thank you very much. Sachin, if you want to come in, what is your own kind of perspective? Domestic, yes, things perhaps may look a little better after the last 2-3 quarters of sluggish growth and earnings downgrades, etc. At least that's the hope. But suddenly the global environment is looking, a little dimmer. Over the weekend we had Goldman Sachs, which for the second time within a month has lowered their growth forecast for the US, and that's been the big growth driver. What is your sense, Sachin?
Yeah, thanks for having me. So if we see the last 6 months, there also the downgrades which have happened has been to a large extent for the sectors which are export dependent. Wherein there were pricing pressures because of Chinese dumping in a lot of markets, including India, and therefore the profit margins kind of got impacted. Now, what we fear is that we will see the more of the same in the coming year, especially because of the whole the tariff war which we are expecting to kind of blow up. We are all waiting for 2nd of April, that is tomorrow, to see what kind of tariffs, reciprocal tariffs are levied. But it is safe to assume that it will certainly have impact on certain sectors. Which sectors and how much is something that we will have to see. But the overall environment will be, very, very nervous. The growth also would be tepid. You're right. US is also looking at a, impact on the growth. So we in India, considering that we are largely, domestic and not so much external facing economy, the impact would be less. But nonetheless, there will be sectors and there will be companies which will get impacted on that count.
Okay. So, Sachin, do you want to expand on that point? Which sectors or segments do you think are at maximum risk for any possible deterioration on account of the global headwinds?
Yeah, so, if we were to just isolate the risk on account of the tariffs, now, well, we don't know what nature and form they will come in. But some of the sectors where India has a high share of exports, if you see the top 4 would be your textiles, your pharma, your gems and jewelry, and these would be the big ones, and electronics as well. Now, in the recent past, we've increased the share there. Now, there we believe more benign would be something like pharma, because that is non-discretionary and wherein India has a right to win because of the cost competitiveness. So there, if there are tariffs, most likely they will be passed on to the consumers in the US markets, and therefore there is not likely to be any impact on the demand per se. Whereas if I look at the complete opposite, will be say something like gems and jewelry, which is basically your cut and polished diamonds. There the impact could be slightly more, because if the tariffs are levied and if those are passed on to the consumers in US, as such, the demand has been a little weak. And in addition to that, if there is an increase in the cost of buying diamonds in US, that could also impact the demand. Similarly, on electronics, we believe while India has been increasing the share, but we may or may not really have a cost advantage as such, as compared to other some Southeast Asian nations or China. So it will be a play of discretionary spend versus India's cost advantage that will really decide. So we are also very keenly watching how it really pans out.
Yeah, absolutely. A very, very uncertain environment. Let's also get to Mr. Ravichandran for his view. He's from ICRA. So what about you? So let's talk about the FY26 outlook. Which sector do you think could show the maximum improvement in credit profiles? I'm sure there will be a domestic-facing sector or segment. And like we were just asking Sachin, which external-facing sector is at maximum risk because of these global tariff issues that we're talking about?
Yeah, so with regard to the outlook for FY26, I would think consumption should come back, especially with this recent tax cut, that will come into being from the current financial year. And more importantly, we're expecting interest rate reductions in the current year, at least 50 to 75 basis points with the fall in the inflation. That should lead to lower mortgage rates, and that should lead to further pickup in consumption. And parallelly, RBI has done a lot of work with regard to easing the burden on the NBFCs, especially liquidity and reducing the risk weights on some of the unsecured loans and so on and so forth. All that should lead to lower cost of funding for the NBFCs, and overall availability of credit also should be going up. I would think one of the reasons for the slowdown in consumption has been the curbs on this lending. So with the better availability of credit, consumption should stage a comeback, the way I see it. Second lever would be, the continuing capex momentum from the government side as well as the private sector side. While private sector capex was subdued the last financial year, I would think that should come back in clean energy sectors, especially data centers and electric vehicles and renewable energy and so on and so forth. So overall, capex should also see good momentum. That should lead to better credit growth, and a better outlook for those sectors. Otherwise, with regard to the the sectors where one should be concerned, chemicals is one space where we are continuing to be cautious. While margin trajectory is improving, but still there are pricing pressures, and to the extent one has to be watchful. In addition to that, we are quite concerned on the the power distribution per se. Overall, while there has been improvement in pricing discipline, payment track record has improved for the IPPs and other developers, but still we are concerned about the the cash losses being suffered by this discount. So that is another area we are watchful. Otherwise, a lot of investments are happening in the hope that eventually payment discipline will continue. That's the key thing to look at.
No, absolutely. And, these are important factors which we will have to look out for. Mr. Ravichandran, Sachin, Mr. Vemuri, thanks all of you for joining us. A shorter conversation today, but I hope you will join us again once we have more clarity on what comes our way in terms of tariffs, which I think is going to be the big talking point, one way or the other.